Hold on, stop scrolling. Right now, there is a massive, unbelievable disconnect happening with OpenDoor Technologies, ticker Open. You are seeing the stock crushed day after day, week after week. But what if I told you that the people who really move the market, the big money institutions, are doing the exact opposite? We're talking about unjustified sell-offs, administrative errors, and massive short interest battling huge institutional buying. By the end of this video, you will know the real data that is driving Open, not just the noise. Stick around, because this is the most critical time to understand what's happening. Let's start with the current mess. Today was supposed to be the day. Following Nvidia's home run earnings, the market was primed for a tech rally. Yet, OpenDoor lagged, dragging down 2.77% on heavy volume of over 62 million shares. The main culprit? A deluge of economic data that the market simply couldn't digest. We got that massive non-farm payroll number, 119,000 jobs added, an epic beat against the 50,000 forecast. That's a strong consumer signal. But then, unemployment edged higher and initial jobless claims spiked due to the ongoing economy shift. This mixed bag is causing Wall Street confusion, and that confusion translates to volatility in stocks like Open. The one key takeaway from all this is that while the labor market is strong, consumers are still feeling the pinch. Now, let's look specifically at the real estate corner where OpenDoor operates. Existing home sales came in exactly as forecasted, 4.1 million. That consistency is okay, but it doesn't give bulls the fuel they need. But the real optimism killer came from a prominent Federal Reserve speaker, Governor Cook. She signaled a possible market correction, citing high valuations across the stock market. This isn't just generic Fed talk. This echoes the same warning we heard from Chairman Powell a while ago. Historically, Cook is known to be bearish, and her comments acted like a wet blanket on today's hopeful trading, especially hitting growth stocks. These warnings create fear, and fear is what the algorithms feed on, regardless of a company's fundamentals. You need to understand the crazy, unjustified sell-off that happened yesterday. It was not the CFO's fault, and this is crucial data. We saw a Form 4 and a Form 144 filed showing the CFO selling shares. However, this was done strictly for tax purposes. This is normal. The monumental error was made by OpenDoor itself. They coded the transaction with the code S, which signals a discretionary sale, rather than the correct code F, which signals a transaction for tax purposes. A simple coding error by the company, that is it. You can see in the actual notes that they tried their best to clarify it was for tax purposes, but the code is what the high-speed trading systems read. This coding mistake, this very unfortunate technicality, allowed short sellers and algorithms to trigger a mass sell-off based on false premises. This isn't a fundamental issue. It's an administrative screw-up that cost the stock heavily. Now, let's talk about the pressure cooker. Short interest. Shorts are playing their game ruthlessly, and they return every time the stock sells off. Currently, they have increased their positions by about 183,000 shares, bringing the total shorted float to a staggering 20.88% of the free float. That works out to over 138 million shares being shorted. This level of shorting is why the stock acts so heavily when negative news, even accidental news, hits. It is unfortunate, but some are even calling OpenDoor nothing more than a meme stock because of this volatility, which is a real disservice to the company's long-term business model. Despite this crushing pressure, there is a clear signal of optimism in the options market. Look at the data, 3.4 million in calls versus 1.4 million in puts. Overall, 48% of all options activity is bullish in nature. This tells you that while the price action is controlled by shorting and algorithms, the conviction among smart retail and momentum traders remains strong. Bulls are targeting above $7 while bears want to drag it below $6. The options data shows the fight is fierce, but the optimistic position is still dominant. Here is the most critical part of this analysis, the one you need to focus on. Who is actually buying? Looking at transactions on the secondary market over $100,000, we see undeniable evidence. Big money is buying the dip. We are seeing huge transactions on the dark pool, like one massive 13.7 million transaction that occurred right near the bottom of the day's range. While the dark pool is designed for anonymity, the size and timing of these transactions signals major institutional accumulation. So, why is the stock still going down if big money is buying? The unfortunate truth is that algorithmic trading has become extremely powerful. If the AI is programmed to feed off the negative headlines, like the Fed's warnings or the CFO coding error, it doesn't matter if an institution is buying 1 million shares, the sell pressure from the automated systems can overpower it. If you like to follow what sophisticated money is doing, the signal is clear. They are accumulating at these low prices. You need to decide whether you follow the emotional, algorithmic fear or the quiet, systematic buying of institutions. Let's quickly review the chart to see where we stand technically. Today, the stock traded exactly between its key support and resistance levels, specifically between the S1 and S2 pivot points. The low of the day, $6.35, bounced right off that strong support at $6.38. This shows a technical floor is holding firm. The next strong target we need to overcome is $7.03. The stock is currently wedge-bound between the 10-day moving average and the 100-day moving average. A breakthrough above that 10-day average is what the bulls desperately need to signal a proper recovery. While the chart overall is not looking fantastic due to the selling pressure, the fact that we bounced right off major support is a key sign that the institutional buying is physically holding up the floor of the stock. We need more news, more analyst ratings, but for now, the technicals show a tough but defined battleground. To wrap up, let's zoom out to the bigger picture. OpenDoor is an AI-driven real estate operation. They use artificial intelligence to optimize their buying and selling processes. The phenomenal earnings from Nvidia should not be underestimated, as they provide strong evidence that the AI thesis is not a bubble. It is a fundamental shift in technology. This long-term strength in AI should benefit OpenDoor greatly. The stock is currently being held hostage by macro forces, the unpredictable Federal Reserve, and the ruthless algorithmic selling driven by fear. Based on the Fed minutes that came out yesterday, it feels like even the policymakers have no clear direction, which only adds to the market's volatility. Do not forget the core data. Big money is buying, optimism is high in the options market, and the AI tailwind is real. The current selling is an opportunity for those with a strong long-term conviction. So, what are your thoughts on OpenDoor right now? Are you buying the dip with the institutions, or are you waiting for the fear to completely subside? Let me know your thoughts in the comments below. And if you found this deep dive helpful, please hit that thumbs up and subscribe for more unvarnished market data. We'll see you in the next one. This video is for educational and informational purposes only. It does not constitute financial advice to buy or sell any stock. Always conduct your own research before investing.